Today, we're doing a deep dive into one of the market's most interesting and, honestly, most misunderstood indicators, the SKEW Index. It's basically the Black Swan Index, and boy, is it telling a story right now. Let's get into it. So, what is the market really afraid of? You might think you know the answer. Recession, inflation, some geopolitical flare-up. But it's usually not that simple. See, it's often not the risks you know about that do the most damage, but the ones lurking just out of sight. See, the real deep-seated fear isn't just that the market will move around, it's that it will suddenly nosedive in a way that nobody sees coming. That's your black swan event. And there is a specific index that tracks this very specific fear. And right now, its needle is way into the red, signaling a level of danger we just haven't seen in a very long time. All right, so let's peel back the curtain and look at the actual numbers behind this hidden fear. Okay, here it is. The number that's got a lot of people talking, 160.53. Now, on its own, that might not mean a whole lot to you, but in context, this number is basically a giant flashing warning sign. And here's why that number is so important. A reading this high puts us in extremely rare territory. I mean, we are talking about a level of perceived catastrophic risk that's even higher than what we saw during major historical crises. So, the bottom line is, the market is pricing in something pretty unique right now. So what exactly is this index? Think of it as the market's early warning system for a sudden, sharp, totally unexpected crash. It's not looking for the everyday jitters, the usual ups and downs. Nope. This thing is specifically scanning the horizon for a monster wave, a huge downside shock coming in the next 30 days. Now, you've probably heard of the VIX, right? The market's main fear gauge. But SQ is measuring a totally different kind of fear, and you really have to understand the difference to get the full picture. What's really cool here is how it separates these two ideas. The VIX, that tells you how bumpy the ride is going to be. Could be up, could be down. It's like the market's general anxiety level. But SKEW? Oh, SKEW is way more specific. It's laser-focused on the fear of a sudden, catastrophic drop. So yeah, a high VIX means turbulence, but a high SKEW? That means traders are looking over the edge of a cliff. And this is what makes them such a powerful combo. They don't move in lockstep. In fact, they're statistically uncorrelated. This is why SKEW is so important. You can have a market that looks totally calm on the surface, right? VIX is low, everything seems fine, but underneath, SKEW is screaming, telling you there's this deep, underlying fear of a sudden collapse. It's the absolute definition of hidden tension. So how in the world do you turn a feeling of dread into a hard number? Well, it's actually pretty fascinating, and it all comes down to a simple idea: disaster insurance. Okay, so the secret sauce behind the SKU index is something called an out-of-the-money put. Now, don't let the name scare you. The easiest way to think about these is just insurance policies. That's it. Big money investors, they buy these things to protect their huge portfolios if the market suddenly crashes. And this right here breaks it down perfectly. It's a simple chain reaction. First, investors get scared. They're worried about some black swan event out of nowhere. So what do? They rush to buy that portfolio insurance we just talked about, those OTM puts. And just like with anything, when demand skyrockets, the price of that insurance goes through the roof. The SKU index, it's literally just tracking that price. So a high SKU just means that disaster insurance is crazy expensive right now. Okay, so we know what it is, we know how it works, but what do these numbers actually mean? Like, how do we translate a number like 160 into something we can actually use? Thankfully, the exchange that created the index, the CBOE, they gave us this handy little guide. So a SKEW of 100, that's your baseline, totally normal. It means there's about a 2.3% chance of a big drop, which is what you'd expect statistically. But look what happens as that number climbs. The implied probability of a really bad day just keeps going up. And, well, you can see right where we are now, way up over 160, deep in that extreme concern zone. Yeah, let's put a really fine point on that. A SKEW over 160 means the options market is pricing in about a 15% chance. Think about that. That's more than 1 in 7 of a major 2-standard deviation drop in the next 30 days. Now, to put that into perspective, that is a probability that is 6.5 times higher than what a normal, boring market distribution would ever suggest. It's just a massive signal that the so-called smart money is willing to pay a huge premium to protect against a sudden crash. All right, let's bring it all home. What does this crazy high SKEW reading mean for us, right here, right now? What are the big takeaways from all these warning signs?
So, what's the bottom line here? First off, it means that protecting your portfolio against a drop is incredibly expensive right now. Second, the options market is taking the idea of a black swan event very, very seriously. Now, what could cause it? Who knows? It could be anything from stubborn inflation to geopolitical risks, or just the fact that valuations are through the roof. But whatever the reason, the core message is the same. There's this huge disconnect between the calm surface of the market and this extreme fear that's churning just underneath.
And all of this leads us to the final and most critical question. You have to remember the SKEW Index isn't a crystal ball, right? It's just measuring the perception of risk. It's not a guarantee that something bad is going to happen. So that leaves us with this huge question. Is the market acting like a brilliant canary in a coal mine, sensing a danger that the rest of us are missing? Or is it just freaking out, paying a record-breaking premium for a false alarm that's never going to go off? That right there is the billion-dollar question.